Appreciate that. It's a pleasure and honor to be here today to discuss one of my favorite topics, cash flow and forecasting. I love this topic. I use it as a cornerstone of my work as a CFO with my businesses. My goal in working with my clients is always improving their cash flow and profit, um, and ultimately their company value. Had quite a bit of experience. I've actually been doing cash flow forecasting for, I was calculating before we started today. I think it's been about 35 years when I started co-founded a home building business. And one of the first issues that I became aware of was the size of the numbers of cash. We got big numbers cash flow in, and we had big numbers cash flow out. And it occurred to me that I needed to develop some way of being able to look into the future with cash flow. So I've been using it for about 35 years now. My goal today for you folks that are listening is to persuade and motivate you as to why it's not only important in this unprecedented time, but why it's always important to be forecasting your cash flow. I think I've got probably more people paying attention now to cash flow forecasting because of the impact of COVID-19. So let's talk about what is forecasting. The forecasting is quite simply just the process of making predictions of the future based on past and present data. A lot of times our forecasting will use what's happened over the last 3 months, 6 months, year, and look into the future as a way to predict it. I think the challenge nowadays is that our future is not as clear as it used to be, and therefore we have to get better at developing different models for looking into the future. If you do not forecast your cash flow as a business person, you're in the majority. Few of my clients, before I started working with them, ever did. I think part of it is that it's difficult to determine where to start in putting one of those together, which is we'll be talking about that later on today to give you a starting point. As business owners, many of you have an intuition about how your decisions impact cash flow. But the question is, do you monitor your intuition against the results? And my guess is that not many do. So, and this is an interesting fact, is that most decisions to increase our cash flow actually reduce our profit, unless the cash is coming directly from profit, which we'll be talking about in a few minutes. So here's what we're going to cover today. I wanted to talk about what is cash flow and why it's important, the difference between profit and cash flow, how to prepare a forecasted cash flow. I want to talk about really how to get you started to prepare a forecasted cash flow, and then how often should I be preparing a cash flow forecast. So what is cash flow? Cash flow is simply the movement of cash through our business for a period of time. So when we talk about cash flow, we need to put a period of time. We say, well, I'm having positive cash flow. Well, is that for the last year, or is that yesterday or the last month? So we really, when we talk about cash flow, we want to talk about it in terms of a period of time. You can run a business at a loss. You can't run a business without cash. So we all know cash is king. Cash is the lifeblood of any of our businesses. So I want to talk a little bit about positive and negative cash flow, which should be pretty simplistic. But basically, positive cash flow for that period of time is if you got more cash coming in than going out, then we call that a positive cash flow. If you have more cash going out for a period of time than you have coming in, that's negative cash flow. And I'll tell you that all businesses have periods where they have both positive and negative cash flow. I've seen very few businesses that where it's strictly positive cash flow. They may have positive cash flow from their operations, but overall maybe they're investing into the back into the business, or maybe they're taking money out as dividends. So we have in business we always have over periods of time both positive and negative cash flow. And so a negative cash flow is not necessarily evil and the worst thing that can happen to you. It is if it's long term, and it has been happening, and we don't see that changing. And that's the reason for putting together a cash flow forecast. So let's talk about the different types of cash flows that are running through our business. So every business has 3 different types of cash flow that are happening. I think the one that we're most familiar with is what I would call the operating cash flow. This is the amount of cash that we generate from the actual operating, the day-to-day operations of our business. It includes not only the operations, but what's changing in working capital, what's happening with our receivables and inventory and our payables and our loans. And it's the operating cash flow. In order for us to produce over the long term positive cash flow, we absolutely have to be producing cash flow from operations. We'll talk a little bit more about that. So the next type of cash flow that we have is what I call investing cash flow. And this is the cash flow where we put money back into the business. Maybe we need to purchase some what we call CapEx, capital expenditures. We're purchasing long-term assets. Maybe we need to buy some more machinery, or we need to buy some more trucks, furniture, computers, whatever that is. And if we don't borrow money to do that, then we're reinvesting. We're actually taking our cash flow that was probably generated from operations and reinvesting it back into the company. Typically there needs to be some level of investment back into our companies, particularly if we're a growing company. There's always a reinvestment back into the company of some sort. Interesting that Warren Buffett, when he's looking at businesses, I had read this article about how he looks at businesses financially, and one of the things that he looks at as a key indicator for him is what he calls free cash flow. And basically, in the way the article described the way that he looks at it, he looks at a company that has both positive operating cash flow, and then he deducts out the investing cash flow to determine if they in fact have a positive cash flow that is needed in order to not only stay healthy but to repay their investments or pay dividends. So that's an indicator that I look at with my clients is, are we producing free cash flow? The final cash flow happening in your business is the financing cash flow. And this is basically the money moving between the owners, investors, and creditors. This is where if we borrow money, if we put money in as an owner, or if we take money out and as we repay loans. So we've got this for those of us that are taking on debt, either now or in the past or in the future. This financing one is one that has to be watched as well, because it's an indicator of how much of our operating cash flow is actually going to financing. And when we add these 3 cash flows together, and as operating cash flow, we want to be positive. Investing cash flow typically is going to be negative unless you're selling an asset. And then financing cash flow can be either plus or minus. When we add the three of those together, that really determines our cash flow for any period of time. And for many of you, I don't know, I'm always surprised when I sit down with my clients for the first time, and I ask them, do they receive the statement of cash flow, which is what I'm showing you on the screen right now. It's one of what we call the three main statements when we're looking at financials: the balance sheet, the income statement, and the statement of cash flows. And what the statement of cash flows does is it really takes those three cash flows that are happening in your business, and it puts them into a numeric form to show what happened during that period of time, whether it's the month or year to date. And so the top part of this statement you'll see is the operating activities. And so it starts with what is our net income? And then what are all of the changes within our working capital, our current assets, if you will, and our current liabilities? In this case, you can see that their receivables went up, so which was a use of cash, meaning that they reported income, but did not collect receivables. Therefore, their cash position went down. So what the statement of cash flows does in the operating is it goes through each of those individual components of current assets and current liabilities and said, did you increase or decrease your cash? And then at the bottom, it will show you what your net cash provided from operating activities. And you can see in this example that they had net income of $99,000 and they generated $96,000 of net cash. So when I would look at that with an owner, I'd say, yeah, that's great. You're managing your balance sheet as well as your income statement, producing cash. The next example is they invested in some computer equipment, and the accumulated depreciation, it's a non-cash asset, so it just gets added back. So in this case, they spent about $1,600 on investing. And then the financing, it looks like the owner took a draw probably to pay taxes, or maybe this particular owner was not taking a salary. So when we look then at the three components, we actually, the net cash flow for the period was actually a loss of $27,000. So they used, even though they were generating it from operating activities, and they used a little bit in investing, the financing activities really decreased their cash flow. So when we look at this business, we say, well, they had a negative cash flow for that period of time. When we look at it all together. So while it looked initially like it was going to be positive cash flow because of the operations, in fact, it was not a positive cash flow. It was a negative cash flow. If you are not getting this statement from your accountant, in either internal or external, I would really encourage you to make sure that you start looking at this one and understanding it. It's to me, it's one of the important statements, because as business owners, and having been a business owner, the cash was always where my eye was going, because as I said before, we can run on a loss, but we can't run without cash flow. We got to make sure that we have it. This does a great job, the statement of cash flow, of really showing you where your cash flow is going and what the components of changing it. I will tell you also, as we get into forecasting, understanding this statement too will help you do a better job in your forecasting. So let's talk a little bit the difference between profit and cash flow. I think most of us know that profit is basically our revenues less our expenses, our costs and expenses, and for a period of time, that difference makes up profit. Cash, it's what's in our bank at any point in time. That's the difference. I like this example though, is that revenue, the profit is really an accounting concept. So it's theoretical. I'd heard that the first time I heard that, I had to really think through that. But basically, profit is a concept, and it's an accounting concept where we match revenues and expenses. That's what we do as accountants, is to say, okay, well, I'm not going to recognize the revenue unless I have the associated expenses with it. So we're always looking at how to make that happen. And so it becomes an accounting concept. And as you probably know, if you've worked with your accountants, that number can be changed easily with journal entries by saying, oh, you can't accept that revenue, you can't record that revenue yet because you haven't earned it. I see it a lot in construction companies where the percentage of complete going ahead, and they can't recognize the revenue even though they billed for it. What's in your bank is what we call real. We all know that. That is the basic difference, is that cash is real. That's what we have to spend at any given time. So profit is a concept. It's a theory. It can be I don't want to use the word manipulated, but it can be influenced as to how that gets recorded. So I'd like to move into now how to really start working on preparing a cash flow. As I said earlier, it's I've been doing this for 35 years. It's been, I think, one of the key tools that I bring to my clients, even in good times. I've worked with clients where they actually had more cash. They had more cash in their business than they needed, and to me that was not necessarily a good thing, because you're putting it at risk, what we call creditor risk, but actually it's at risk all the time. It's in your business. So by doing cash flow forecasts, we were actually able to convince them that they didn't need all that money, and that they should be taking and getting it out of the business to reduce their risk with it. So let's talk about the cash flow forecast. And basically, when we're doing a forecast, at the highest level, all we're doing is we're saying, here's my beginning cash. I'm going to add all of my sources of cash for a period or periods of time. And then I'm going to deduct all of the uses of cash. And that's going to tell me what my forecasted cash balance would be. I will tell you that having an operating budget makes this whole process of forecasting a lot simpler. You're going to have to go through the same type of looking at your business in terms of where your sales coming from, how much in sales. You're going to have to look at your variable expenses for cost of sales. You're going to have to look at your fixed expenses. So having an operating budget already in place will make this a lot easier. In fact, when I work with my clients, when I'm preparing an operating budget, I call it a profit plan, simply because I think it's easier. People get on board to put together a plan to make profit, where operating budget sounds pretty dull and boring. So basically the same thing. When I do the profit plan, I always include the forecasted cash flow for the same period of time. So having the budget, as I said, makes it a lot easier. So let's look at what we need to be looking at when I talk about sources. So sources we really have to understand how cash flows through our business, not how profit. So for example, if we are selling, for example, on an e-commerce, then our cash sales are going to be the same. They're the same number. Revenues and cash flow would be the same, because we're collecting immediately. there may be a day or two delay, but effectively immediately you're collecting the source, the cash from the sale. As I look at businesses, these are common, but not every business is going to have every one of these, but most businesses will have one or more of these. Deposits. Some business run on a construction, again, where we are getting customer deposits before we start work. You'll see that both in residential, commercial construction. I would say some service businesses will also collect deposits on contracts before they start work. So that's a source of cash, even though it's not revenue. It is a source of cash for us. Obviously, accounts receivable collections are a big source of cash for those of us that are selling on time or credit. Accounts receivable collections is a real challenge for forecasting. I have spent a lot of time trying to look at history to determine how to predict receivables, and a lot of times what I end up doing is looking historically and saying, on the average, for the last 3 or 6 months, they've been collecting 68% of their receivables every month, or 82%, or whatever that is. I have recently been working with a company that has some software that actually goes down and looks at it uses algorithms to go down and look at individual customer level, their kind of payment habit, and be able to forecast collections into the future. And I've been monitoring that, and I've been pretty impressed. Over a four-week period, their forecast, what they forecast the actual collections, runs about 90 to 95%. So for those of us that are doing forecasting on a regular basis, that's good news. So I just understand that you'll get better with forecasting your sources of AR collections. The more you do it, the more you analyze it. Some companies have notes receivable payments out there. That's a source of cash. We've got loan proceeds. I'm sure many of us, hopefully many of us on this call, have got the PPP loan. So getting those loan proceeds would be a source of cash. It could be a working capital line from your bank. It could be a capital injection. It may be that you have to either through investors or yourself have had to put money back into your company. So that would be another source of cash. So this is what I'm showing you now is just an excerpt of how I set up a forecast. It's pretty simplistic. It's just identify the sources, and I'll break down the sources by month. But I think what's important about this too is that, and obviously I use Excel for this. I have not found for most businesses a off-the-shelf model that works for businesses easily and does the documentation that you need to of your assumptions. So I've used Excel. I start with a template that I've developed and then just modify it for each client. But each of these different sources would have a tab in the Excel workbook to really document the assumptions about, well, where did the cash sales come from? Who was I planning on getting customer deposits from? And what was the calculation on that? So each of these then would have an assumptions page tied to it. And the reason for that is that when you first start doing cash flow, it's going to be reasonably accurate. And what's going to happen is that as you begin to monitor what actually happened against your assumptions, you'll get better at forecasting, and therefore you want to have your assumptions in place and documented so that you can go back later on as you're evaluating it and saying, well, wait a minute, my cash flow didn't come anywhere close to that. What was the assumption that I made? So that's to me the important part of getting this set up. So let's look at the uses side of, how do we use cash? Where does cash go? It certainly goes more quickly than we like it a lot of times. So let's look at the big components. Cost of goods sold. This can be cost of services / inventory. So we need to be able to say, okay, it's not so much my cost of sales percentage of my sales revenue. It's really related to the inventory that I've got to replace for the cost of goods sold. That is the cash component, not the profit or the expense component. And so again, it really takes a different mindset to examine your cash, examine your business as the way that cash flows through it, not profit and expenses. So this number, inventory, for some of you now with what's going on and reduction in sales, the inventory number, you may not be replacing inventory at the same levels that you were before. So it would be important to know what that impact is as you're seeing your sales decline as well. Payroll taxes and benefits. That's the obvious. We all know that employees are the most expensive part of most businesses. I like to, when I'm doing a budget, you'll see that the next several categories are the way that I classify my expenses on the income statement. So it's a lot easier to, rather than your uses listed as 112 different line items, I tend to classify them like what's the cost of my payroll, the taxes related to it, and any benefits that I'm providing. And then I'll take a look. Next category would be sales and marketing. That could include any marketing that we're doing, any advertising, anything that we're doing on the internet, sales commissions and everything. So sales and marketing is another big category. All businesses have those. General and administrative expenses. This is a catch-all for what I would call your fixed expenses of your operation. This is going to be your rent, your utilities, your office supplies, all of those expenses that are relatively fixed just to keep the doors open in your business. And then finance expense. How much are we paying for interest on the loans that we have now, or as we're doing forecasts, if we decide that we want to take out, we need a loan and we can get a loan, what's the cost of that loan in terms of the interest that it's going to cost the business? We want to capture that. We'll also want to capture credit card payments. A lot of businesses I see have multiple credit cards and are using that to fund their operations. Well, those have to be paid back. So what is that cash outflow per month that's required to get your credit cards paid to zero or reduce them? And then loan payments. This is kind of the other part of the finance expense. When we're paying a loan on time, we're paying both principal and interest. So we would want to capture the interest in the finance and the principal in the loan payments. And then hopefully we're taking some level of distribution, a dividend out of the business. We want to track that. I've got companies where, again, particularly during these difficult times, the owners have decided not to take a salary unless they were qualifying under the PPP loan. So they may be taking distributions just to get money into their personal pockets. And then this is another use of cash that a lot of times go unnoticed, because most of the time we're looking at just my operations. But if we need to spend if we have capital expenditures that we're planning on purchasing, it could be a change in your software, it could be your hardware, computers, could be manufacturing equipment, all the things that we talked about earlier. So we want to make sure that we're capturing those in our cash flow, because they are a use of cash, even though they are not an expense of the business. So this is again, this is a snapshot of what the use side of the forecast would look like. And again, I would have, for each one of these categories under uses, I would have a tab in the Excel workbook that would document where these numbers are coming up. And then at the very bottom, this is what I was saying earlier, is that there's my beginning cash of 63,000, and then what I do is I monitor, did I create a surplus or deficit during the month? Did I add cash, or did it take cash to run my operations? And then across the very bottom, I'm calculating what my projected ending balance would be. And in this case, you can see that their cash balance is going down pretty quickly. I think I showed in May that they had gotten a PPP loan in this example. So one of the things that I would look at here is that I would say, okay, in July, we have a burn rate of $33,500. And by that, I mean that it's taking, our cash flow is $33,500 negative in the month of July. And unless we do something to change that, with an $8,500 cash balance, we're not going to be able to sustain ourselves. So by having done this forecast back in April, I would have been looking at July and saying, okay, what are the things that I could do in May and June so that doesn't happen in July? And that's what the real benefit of the forecast is it really helps me look into the future based on these sets of assumptions, to give me an idea of, is there something that I need to do now? What's driving either my positive or negative cash flow, and what do I need to change in order to convert this into a positive cash flow? I understand easier said than done, but what this does is that it's better to know it in April than it is in mid-July that we're going to have this kind of issues. One of the things that I do as I'm working with my clients, just so once this template is developed and once we've documented assumptions, I have found that if there is a bookkeeper or an accountant, that I can usually train them on how to populate this. But to get them to develop this on their own is just not a skill set that they have. They're typically transactional, and they're looking at the business from a profit and expense as opposed to cash flow. So don't assume that you can turn this over to your bookkeeper and or most accountants to prepare this. You will definitely, as the business owner, need to be involved in order to make sure that things are being captured correctly. So, so the next piece of business here is, so how often should I be forecasting my cash flow? And I think that times have changed. For all of us, I'm with my clients, I'm counseling them that they really need to prepare two different scenarios in their cash flows every time we do one. One is what I called the hopeful cash flow. This is what we think could happen based upon what we know today. And then I have what I call the coronavirus scenario, which is what's that worst case look like? What if not only do we quit making sales, but collections slow down for receivables, or it takes us 90 days to get our pipeline filled. So I think that at this point, whenever we're doing a cash flow, we need to be doing two cash flows. And, one is the hopeful, one is what we think can happen with the changes that we know about. And then the next one is really kind of what's the worst case. So I would tell you that it's the criticalness of your cash that determines the frequency of how often and for what period of time you should forecast cash flow. Again, with my clients, I'm recommending that they do a 6-week, which is a near-term cash flow, where each column would be a week. So they would have 6 1-week looks into the future, just to make sure that there aren't any negative cash periods during that 6-week. So if it's critical to you, which it is to a lot of businesses right now, and for those that aren't, that are less critical, the 6-week is probably not necessary. But what I do recommend is, even if you are doing a six week, that you also prepare on a monthly basis, that you prepare a 3-month forecast. So here we are in June. I already would have June, I would have a forecast that would have already been done in May, that would have been June, July, and August. And then by July 1st, I would have a July, August, September one. So I'm always looking out 3 months. And again, having this hopeful and pessimistic or coronavirus scenario for you to be looking at. So it is a lot of effort to do this, but I think once you get your template set up for your business for forecasting, it really does not take that long to keep it updated. And the thing is that it becomes a great tool, especially now with cash being a challenge for most businesses. So key learning points I hope today is, one is that you understand how cash flows in order to manage it. And that's the critical thing, is that we all as business owners need to understand how cash flows for a business. If we don't, we can't manage it. So we've got to look beyond, generating more revenues is going to fix everything. We also have to understand the cash flow impact, and that businesses need both profit and cash flow in order to stay in business. And as I said before, we have periods of negative cash flow, but we can't sustain that over a long period of time. Another area is that it's important that we manage all 3 areas of our cash flow. Again, I think most of us are focused on the day-to-day operations and understanding our operating cash flow, but are we factoring in both investing and financing parts of the cash flow too, as we look at our management of cash flow? So make sure, now that you understand the difference, that you in fact are going to manage all 3 areas of cash flow. So suggestion: prepare an operating budget. I think operating budgets, much like the forecasted cash flow, you can start at a fairly high level. You don't have to dig down into the minutia, although as I think most of us know, with cash, the devil can be in the details. So have enough depth in your operating budget that you can convert that easily into a cash flow, and develop a forecasted cash model for your business. Get help. There are a lot of CFOs out there. That's as a CFO, what differentiates us from a controller and other accountant types is that we're looking where we are and where we're going. We're looking into the future. And so forecasting is a skill set that most all CFOs have, besides strategic planning. Cash flow forecasting is both a science and art. And by that, I mean, I could go into two very similar companies and their cash flows would look different because of what I call the science is really, you know, basically the number side. The art is what's important to you. You know, some companies want to keep their employees at any cost, and they want to keep them, and they're not willing to let employees go at this point. So it really, the art part is, what's your culture? What's your business? How do you, you know, what do you want to protect if you had to make decisions about cash flow? And then lastly, with the forecasting cash flow, repetition improves learning. The more that you do this, the better you will get at it, the more efficient and the better predicting it. I will tell you, all the cash flows that I do, I have never had a cash flow come out exactly the way to the number that I had forecast over a period of time. It gives you a glimpse into the future and gives you some parameters of it gives you a range of what your cash flow is going to look like. So it's not intended to be an exact number and why didn't we hit that exact number. It's really more understanding what the drivers are, both for cash coming into your business and cash going out of your business, to maintain that focus on making those things happen. So Alexandra, that is it. I'm going to turn it back over to you.
Yes, thank you so much, Rick. That was just jam-packed with some great information. I know I learned a lot myself. It does look like we did get some questions that came through. The first person
Okay.
asks, which is more important, profit or cash?
I can't tell you how many times I get asked that question. That's a great question. And I, you know, the answer is they're both important. But I would tell you that over the long haul, that it's going to be profit that is going to create the cash flow for your business in order to sustain itself, and not only sustain itself, but generate you know what business owners are looking for, which is the ability to exit their business, take money out of the business. So it's profit, although, you know, we have to manage both. I think it's we have to manage both, but so many times when we choose to improve accelerate our cash flow, it costs us profit. That an example would be if we need to go out and borrow money to make our payroll for a short period of time because our receivables or we've got a seasonal business, that costs us profit. We have to pay interest on that money. If we go out and get a partner, that costs us equity. So while they're both important, you know, over the long term, profit is what's going to generate that cash flow, that free cash flow.
Great. We just got about 4 more questions that just came in. The first one asks,
Okay.
how often should a business owner receive a statement of cash flow? Is weekly enough?
No, I would say that if you're receiving your statement of cash flow as part of your monthly financial package, that would be sufficient. That the statement of cash flow is what happened in your business. So much like the balance sheet and the income statement, it's looking at the past. Where the forecasting, a 6-week cash flow forecast would tell him what's going to happen in the future. So I produce it as part of a monthly financial package for my clients with their monthly financials, and I provide not only the statement of cash flow for the last month, but then where we are year to date on our cash flow as well.
Hmm. Makes sense. And if a business owner is just starting out with cash flow, can they just do operating cash flow to start and then add investing and financing later on?
Well, the beauty of the is most smaller businesses and businesses that I mean I've got businesses that are 20 and 30 million dollars are on QuickBooks. It's a standard statement that comes out of QuickBooks, so it's really easy to produce, and it's really so when you produce the statement, it's going to have all of the components, and you're always going to have um, the investing and financing are come off of the balance sheet. So it's a given that they would be the information would be produced as part of that statement of cash flow. If I answered the question, if I got that right.
Yeah, I think so. If not, we have your information as well, and we're going to
Yeah,
be sending that out, and he can email you. Another person
perfect.
asked, this woman wants you to explain when you said too much cash is putting it at risk. Can you explain that a little bit more?
Yeah, we even if we incorporate our business and we have the protection of legal protection as a corporation, as in a business, we can determine the amount of optimal, what I call optimal cash that we need in the business by there's a calculation that we can use to determine what the working capital is, and that's basically the cash that we need in the business is our working capital to keep the business going. And then we can also add in and say, well, if I want to grow my business, how much more working capital would I need in my business? And by looking at that, we can determine the optimal amount of cash and working capital that we need in the business. The reason that we want to take it out of the business is that it's at risk as a business. It's at risk for litigation. It's at risk for credit if there's a default on a loan. If the money is in the business as opposed to out of the business, it's easier to get if there were a judgment against the business. So I think that the other thing is that we are probably not using the cash in the business in a way that is going to get a return on the business. So another way of saying that is after we've got the optimal amount of money in the business, we're not getting and let's say that our return on assets is we're getting a 25% or 20%, 15% return on that. We may have other opportunities outside of our business to get those or better returns by investing it in real estate, for example. Or we are not going to leverage that cash in the business to continue to get just because we're getting a 25% return on assets. If we have too many assets in the business, we'll get a lower return on it. So we really want to look at it between not only the business but also personal. I work primarily. My goal in working with my business is to optimize and generate the highest amount of profit and cash flow for them to be able to then take out personally and manage that to get returns there as well. So I think that it's most businesses are so busy trying to grow that they never look at the fact that they may have reached that point in their growth where they just have too much cash in the business, and they really, my recommendation is always to get it out and get it working outside the business.
Wonderful. It looks like we have time for two more questions. This person asks, regarding direct versus indirect method, when should we use one or the other?
You're talking about statement of cash flows?
Yes.
Yeah, I like and I think it's the one that QuickBooks used, I believe, is the indirect method. I find it easier to understand, and also QuickBooks doesn't do the direct method. So I just find it easier to understand as a business owner than I do the direct method. Um, in order to do the direct method, though, you'd probably have to get your CPA involved, and they would have to develop a template, an Excel template for you to drop numbers into. So if for no other reason, the ease of the way that the information is found within QuickBooks, but I also think it's just easier to understand.
Wonderful. This last question asks, I've never seen the statement of cash flow before. Why is it important to understand it?
Well, I think, to me, the statement of cash flow, I think that as business owners, particularly if we are the rainmakers, we're looking at revenue all the time, and we're out there and you're growing our business through revenue, and hopefully taking a look at the profitability of the business. But what I like about this statement of cash flows is it really reconciles, because I can't tell you how many times that I've gone and talked to a prospect and they said, I'm as big as I've ever been, and my cash, I have less cash. How can that possibly be? And so what I do is I take out the statement of cash flow, and I can then show them, and I can reconcile in their mind kind of the revenues and the profit to the cash flow. So I think it's just a great statement for reconciling, income to cash flow, because a lot of business owners don't recognize the impact of the investing and the financing part of the cash flow that is happening in their business, whether they are intentional about it or not.
Great. That makes sense. Rick, again, thank you so much for joining us today. That just has a lot of wonderful information, and I'm sure you're going to be getting some more questions later on.
Please, yeah, please send. I'm happy to engage in email or conversation, whatever works. So don't hesitate.
Yeah, perfect. Again, everybody remember that after this presentation, we will be sending a copy of the slide deck and the recording. You'll have all of this information if you do have any questions that pop up. I hope all of you can check out all of our previous Boss webinars on demand by visiting our website and clicking on webinars. I also hope all of you can join us on June 17th for a webinar featuring expert tips on how to look your best on video calls. Thank you everyone again for joining us today, and have a wonderful rest of your day.